for a brief moment in the early 2000s, one app didn't just disrupt dating. It reprogrammed how millions of people thought about connection itself. What used to be awkward coffee shop meetings, carefully written online profiles, or blind dates set up by friends suddenly collapsed into a single motion of the thumb. A right swipe meant possibility. A left swipe meant rejection. It was fast. It was frictionless. And it was addictive. When Tinder launched in 2012 out of Hatch Labs, an incubator backed by IAC, it didn't look revolutionary at first glance. The founding team, including Sean Rad, Justin Mateen, Jonathan Badeen, Joe Munoz, Chris Goshinsky, and Whitney Wolf, wasn't inventing online dating. That already existed. Platforms like Match.com and OkCupid had been around for years. What Tinder did differently was radical simplicity. Instead of essays and compatibility algorithms, it leaned into instinct. Photos first, decision second, conversation only after mutual interest. The brilliance wasn't just technical, it was psychological. The app turned romantic discovery into a game loop. Swipe, match, dopamine, repeat. It spread through college campuses like wildfire. Early growth strategies targeted fraternities and sororities, creating localized network effects. If everyone around you was on Tinder, you had to be on Tinder too. By 2014, users were swiping an estimated 750 million times per day, generating around 10 million matches daily. Investors began whispering billion-dollar valuations for a company that was barely 2 years old. But the seeds of future tension were already planted. From the beginning, Tinder's core mechanic, gamified intimacy, made it thrilling. Yet that same mechanic subtly trained users to treat people like inventory. Infinite choice feels empowering at first. Over time, it becomes exhausting. But in those early years, few were questioning the design. Growth covered everything. Internally, however, the company was far less stable than its soaring metrics suggested. In late 2014, co-founder Sean Rad was removed as CEO following a sexual harassment lawsuit filed by a former executive. Though he later returned briefly, the episode marked the beginning of leadership turbulence that would follow Tinder for years. At the same time, another fundamental challenge loomed. Money. Users loved Tinder because it felt free and effortless. But venture-backed companies cannot survive on vibes alone. The pressure to monetize was mounting, especially as IAC prepared to spin off Match Group as a public company. In early 2015, Tinder introduced Tinder Plus. For the first time, users were asked to pay for features like unlimited swipes and the ability to rewind an accidental left swipe. It was a pivotal moment. The company had to answer a dangerous question. How do you charge for something that feels like a casual game? Charging risked breaking the illusion. On one side was Wall Street demanding proof that Tinder could generate serious revenue. On the other side were users who believed the magic came from its simplicity and freedom. Every paywall subtly altered the experience. Unlimited swipes, for example, quietly reinforced the idea that attention itself was scarce and purchasable. When Match Group went public in November 2015, Tinder was clearly positioned as its growth engine. Investors were buying into the swipe, and for a while the bet paid off. International expansion accelerated. Paid subscriptions converted more free users than many analysts expected. By 2016, profits were climbing, largely driven by Tinder's momentum abroad. Yet beneath the surface, something structural was forming. The app's success depended on keeping people engaged, but not necessarily satisfied. If users found lasting relationships too quickly, churn would spike. If they became frustrated and quit, revenue would suffer. The company had to maintain a delicate balance. Create enough hope to keep people swiping, but not so much success that they left. This is the paradox at the heart of swipe-based dating. The more efficient the system becomes at creating real-world connections, the less time users spend inside it. But the less meaningful the matches feel, the more burned out users become. Tinder thrived in that tension during its early years. It felt exciting, new, culturally defining. Swipe left even entered everyday vocabulary as shorthand for rejection. But cultural dominance can be fleeting. As Tinder scaled into a global brand, the internal pressures of monetization, executive instability, and public scrutiny began reshaping its identity. What started as a playful experiment in frictionless dating was becoming something larger and heavier. The app that once symbolized spontaneity was now a publicly traded growth machine. And machines, unlike college campuses, don't run on vibes. They run on quarterly earnings. The swipe had conquered the world. But in doing so, Tinder had tied its future to a mechanic that rewarded engagement over depth, volume over meaning. By the late 2000s, Tinder was no longer a scrappy campus experiment. It was the crown jewel of Match Group, the company that owned a portfolio of dating brands and depended heavily on Tinder's explosive growth. Financially, the app was thriving. Culturally, it was everywhere. But internally and competitively, the pressure was building. The calm that followed Match Group's IPO didn't last long. In 2018, tensions that had been simmering for years finally erupted into a public battle. Tinder's founders filed a massive lawsuit against IAC and Match Group, alleging that the parent companies had deliberately undervalued Tinder during an internal valuation process to cheat them out of billions in stock compensation. The lawsuit wasn't just about money. It exposed a deeper conflict between the original visionaries and the corporate structure that now controlled the app. The founders painted a picture of financial manipulation and aggressive oversight. Match Group pushed back, denying wrongdoing. But regardless of who was right, the damage to morale and public perception was real. The story shifted from one of innovation to one of corporate infighting. While executives fought in courtrooms, the dating app battlefield was getting crowded. One of Tinder's most formidable competitors emerged from an unexpected direction. Bumble, founded by former Tinder executive Whitney Wolfe Herd, entered the market with a twist. Women had to make the first move. That single rule repositioned the entire power dynamic of swipe-based dating. It marketed itself as safer, more empowering, and more intentional. Bumble wasn't just another clone, it was a critique. It subtly suggested that Tinder's culture had drifted towards something chaotic and transactional, and users noticed. Market share began shifting. The swipe mechanic was no longer unique intellectual property. It was a genre. And once a format becomes a commodity, differentiation becomes everything. But the most interesting threat to Tinder didn't come from outside Match Group. It came from within. Hinge, another dating app under the Match Group umbrella, went through a major rebrand with a bold tagline, designed to be deleted. The message was crystal clear. This app was for people who wanted meaningful relationships, not endless swiping. It was a direct philosophical counterpunch to Tinder. Where Tinder leaned into speed and volume, Hinge leaned into depth and curation. Profiles encouraged prompts, personality, and storytelling. The company openly acknowledged what many users were already feeling: swipe fatigue. By promoting Hinge as the destination for serious dating, Match Group was effectively admitting that Tinder's reputation had narrowed. For many, it had become synonymous with casual hookups and superficial browsing. That brand identity was powerful, but limiting. Still, between 2018 and 2021, Tinder delivered some of its strongest financial performance ever. International growth remained robust. Subscription tiers like Tinder Gold and Tinder Platinum increased average revenue per user. The company had successfully engineered multiple layers of monetization on top of its original free experience. Then came 2020. When COVID-19 lockdowns swept across the globe, dating apps experienced an unexpected surge. Isolated, anxious, and socially restricted, people turned to digital platforms for connection. Tinder saw record engagement, swipes increased, conversations lengthened. For a moment, the pandemic looked like an unlikely tailwind. But something subtle was changing. Users weren't just looking for quick matches anymore. They were looking for companionship. The context of global isolation reframed expectations. In response, Tinder introduced video chat features and expanded social tools, trying to adapt to a world where physical meetings were uncertain. The company also rolled out an Explore section in 2021, allowing users to connect based on shared interests instead of purely photos. It was a quiet admission that the original swipe-only experience might not be enough for the next generation. Gen Z, in particular, approached dating differently. They grew up online. They were more attuned to mental health discussions, authenticity, and social values. Endless swiping began to feel less thrilling and more draining. Meanwhile, the legal saga between Tinder's founders and Match Group dragged on. In late 2021, the companies agreed to a $441 million settlement, closing a painful chapter. On paper, it looked like resolution. But culturally, Tinder was no longer the untouchable symbol of modern romance it once was. As pandemic restrictions eased in 2022, another shift hit. The engagement boom cooled. Inflation squeezed consumer spending. Users who once paid for premium tiers began reconsidering monthly subscriptions. And then came a cultural blow that hit far beyond earnings reports. In early 2022, Netflix released The Tinder Swindler, a documentary chronicling a con artist who scammed women he met through the app. Although the individual had been banned from Tinder, the film cemented a darker narrative. The swipe economy could carry real-world risks. Trust, once taken for granted in the early carefree years, became a serious issue. Tinder responded by expanding safety tools and introducing background check features, necessary steps, but also symbolic. The app that once celebrated frictionless anonymity now had to acknowledge that anonymity could be dangerous. By the end of 2022, the signs were clear. Growth was slowing. Leadership was changing. CEO Renate Nyborg departed after less than a year in the role. Match Group CEO Bernard Kim stepped in to oversee Tinder directly, a move that signaled urgency. The company that once defined modern dating was entering a new phase. Not explosive growth, not cultural dominance, but scrutiny and fatigue. By 2023, Tinder was no longer fighting just for growth. It was fighting for relevance. For over a decade, the app had operated on a simple promise: endless possibility at the speed of a swipe. But what once felt liberating was now starting to feel repetitive. The novelty was gone. The cultural buzz had cooled. And Wall Street, unlike college campuses, has very little patience for nostalgia. The financial cracks began widening. Match Group reported slowing revenue growth and weaker than expected forecasts. Paying subscriber numbers, once the engine of consistent revenue expansion, began showing signs of strain. While overall user numbers remained large, the critical metric, people willing to pay for premium features, was slipping. That mattered enormously. Tinder's business model had evolved far beyond its original free swipe mechanic. Over time, the company layered on increasingly expensive subscription tiers: Tinder Plus, Tinder Gold, Tinder Platinum. Each offered incremental visibility boosts, super likes, priority messaging, and algorithmic advantages. The system subtly transformed dating into a pay-to-compete marketplace. If you didn't pay, your profile might be shown less frequently. If you did pay, you gained priority, visibility, and therefore romantic opportunity became something you could purchase. For a while, users tolerated this because the ecosystem was large and dynamic. But as growth plateaued, the friction became more obvious. By late 2023, Tinder introduced an ultra-premium subscription tier priced at nearly $500 per month in select markets. The plan targeted power users, the most active swipers willing to pay for maximum exposure. On paper, it was a high-margin revenue strategy. In reality, many analysts interpreted it differently. Instead of signaling strength, it suggested desperation. When a platform must extract more money from a shrinking base of loyal users, it often means the broader audience is disengaging. Investors noticed. Match Group's stock price fluctuated sharply following disappointing earnings reports. The company acknowledged that paying user numbers for Tinder were declining year over year in key markets. Saturation in the United States, once dismissed by leadership, began looking very real. Meanwhile, Hinge continued growing steadily within the same corporate family. Hinge's positioning as the app designed to be deleted resonated strongly with millennials and older Gen Z users seeking something more serious. Internally, Match Group began highlighting Hinge more prominently in earnings calls, framing it as the new growth driver. That shift was subtle but profound. For years, Tinder had been the undisputed flagship. Now, investors were increasingly viewing it as a mature, even declining, Asset. Brand perception had hardened. Tinder was seen as chaotic, superficial, and transactional. Whether fair or not, perception influences user behavior. And user behavior drives revenue. As pressure mounted, activist investors entered the picture. In early 2024, Elliott Investment Management reportedly built a significant stake in Match Group, signaling dissatisfaction with performance and governance. Soon after, Starboard Value acquired over 6% of the company, adding another powerful voice demanding operational improvements and strategic change. By 2025, Anson Funds joined the chorus. Multiple activist investors targeting the same company sends a clear message. Confidence in management is fragile. These firms typically push for cost cuts, restructuring, leadership changes, or strategic pivots designed to boost shareholder returns quickly. But quick financial engineering doesn't always solve deeper brand problems. Tinder's challenge wasn't just operational inefficiency. It was philosophical fatigue. After a decade of gamifying romance, users were questioning whether the system truly served them. Swipe-based abundance had turned into paradoxical scarcity. The more options users saw, the harder it became to choose. The more matches they accumulated, the less meaningful each interaction felt. Choice overload led to emotional burnout. At the same time, economic pressure amplified the issue. Inflation and higher living costs made recurring subscription fees less attractive. Dating apps were no longer cheap entertainment. They were discretionary spending. Leadership instability compounded uncertainty. In January 2024, Faye Yosotaluno was appointed CEO of Tinder, tasked with revitalizing the brand. But by mid-2025, she stepped down after roughly 18 months. Once again, Match Group's top leadership had to intervene directly. Frequent executive turnover sends uncomfortable signals to both employees and investors. It suggests that no clear long-term strategy has fully stabilized the platform. Behind closed doors, former employees and executives began speaking more openly about internal culture. Some described an organization increasingly obsessed with metrics. Swipe rates, engagement time, revenue per user. Sometimes at the expense of authentic user experience. When optimization becomes the only goal, humanity can get squeezed out. And that critique cut deep. Tinder's original magic came from spontaneity and simplicity. Over time, layers of monetization, safety mechanisms, algorithm tweaks, and corporate oversight reshaped that simplicity into something more complicated. And to some users, more cynical. By the end of 2024 and into 2025, Tinder faced a rare position for a former cultural juggernaut. It was no longer setting the tone of modern dating. It was reacting. Reacting to competition. Reacting to investors. Reacting to user fatigue. The empire built on the swipe wasn't collapsing overnight. Revenue remained substantial. The brand was still globally recognized, but momentum, the intangible force that once carried Tinder effortlessly forward, had slowed dramatically. And when momentum fades, companies must choose. Double down on the old formula, or reinvent themselves entirely. Tinder chose reinvention. But whether technology alone could fix what culture had changed, that was the real test ahead. By 2024, Tinder's challenge was no longer about building scale. It was about rebuilding trust, excitement, and cultural relevance. The swipe still worked technically. Millions of people continued using the app every day. But something intangible had shifted. What once felt electric now felt routine. The company that invented a new language of dating was now trying to rediscover its own. So Tinder made a bold decision. Lean into technology again. This time powered by artificial intelligence. If the swipe mechanic defined its first decade, AI would define its second. Match Group executives publicly framed AI as a way to repair the very user experience that endless swiping had eroded. Instead of forcing users to manually grind through profiles, Tinder began rolling out AI-assisted features designed to curate photos, suggest profile improvements, and refine matchmaking recommendations. The pitch was simple: less friction, better matches. AI tools could analyze which pictures performed best, recommend prompts likely to spark conversation, and even help users craft bios that felt more engaging. In theory, this reduced the cognitive load of online dating. In practice, it was also an attempt to reintroduce magic into a system that had become mechanical. The company was particularly focused on Gen Z. Younger users approached dating apps with more skepticism than millennials had a decade earlier. Many viewed Tinder less as a romantic tool and more as a chaotic social feed. Attention spans were shorter. Expectations for personalization were higher. AI offered a way to make the experience feel smarter, almost concierge-like. But technology alone couldn't solve Tinder's deeper reputation challenges. Safety had become a central theme. After the cultural backlash sparked by documentaries like The Tinder Swindler and rising concerns about scams and harassment, Tinder invested heavily in protective measures. Background checks were introduced in certain regions. Reporting tools were strengthened. Identity verification options expanded. These upgrades were necessary. They were also symbolic. The frictionless anonymity that once fueled Tinder's explosive growth was now seen as a vulnerability. The platform that thrived on speed had to slow down, at least slightly, to reassure users that safety mattered. Yet every layer of verification added friction, and friction, ironically, was what Tinder originally eliminated to win the market. This was the paradox of maturity. What works brilliantly for growth doesn't always work for sustainability. Meanwhile, investor pressure remained intense. Activist shareholders continued pushing for operational discipline and improved financial performance. Cost reductions were implemented. Strategic priorities were reshuffled. The company had to demonstrate not just innovation, but accountability. At the corporate level, the stakes were enormous. Tinder remained Match Group's largest revenue contributor. Its performance influenced the entire company's valuation. If Tinder stumbled, the whole organization felt it. That reality made experimentation risky. A failed pivot could have consequences far beyond one app. Leadership turnover didn't help stability. After another CEO transition in 2025, Match Group's top executives again stepped in to manage Tinder more directly. Each leadership shift brought slightly different priorities. More AI emphasis, more safety messaging, more monetization tweaks. But consistency was difficult to maintain. And consistency is critical when rebuilding brand identity. By late 2025 and early 2026, earnings reports showed modest signs of stabilization. Engagement metrics ticked up in certain markets. AI features generated curiosity, but analysts remained cautious. The broader dating app market had cooled compared to its pandemic highs. Consumer spending patterns were shifting. Competition remained fierce. More importantly, user expectations had evolved. After years of gamified abundance, many people were craving intentionality. The cultural conversation around dating had shifted toward emotional intelligence, mental health awareness, and authenticity. Swipe culture, once revolutionary, now sometimes felt juvenile. Former insiders have suggested that Tinder's long-term challenge isn't purely technical. It's philosophical. When a platform optimizes for engagement above all else, it risks losing sight of the human outcome. Real relationships don't behave like game mechanics. They're unpredictable, inefficient, and deeply personal. Tinder's future depends on reconciling those truths. Can an app built on volume successfully pivot toward depth? Can AI enhance authenticity without making connection feel even more synthetic? And can a publicly traded company resist the temptation to squeeze short-term revenue at the expense of long-term trust? Those are not easy questions, but they define Tinder's next chapter. The company that once rewired modern romance now finds itself in a different position, not leading a cultural revolution, but attempting a comeback. Its brand remains powerful. Its user base remains vast. Its resources are significant. But the game it invented has matured. After a decade of treating dating like a fast-paced marketplace, Tinder is discovering that many users no longer want to play endlessly. They want outcomes. They want safety. They want meaning. Whether AI, strategic pivots, and corporate restructuring can deliver, that remains uncertain. What is certain is this: Tinder's story is no longer about explosive disruption. It's about adaptation. And adaptation is harder than invention. The swipe changed the world. Now Tinder must prove it can change itself.